Hello and welcome to our session on regulation and supervision of MFIs. Our objective under this session will be to explain the rationale and objectives of regulation, discuss challenges MFI regulators and supervisors face in integrating MFIs into existing regulatory and supervisory frameworks for banks, explain why it may be necessary to ration the number of new licenses issued at early stages, and describe the regulatory framework for microfinance operations in Ghana. Now let's look at the rationale and objectives of regulation. In general, the financial services industry is the most regulated industry as it is assumed that it is subject to market failures. Now let me try and explain. Now, in the typical financial services industry, and strictly in terms of banking, on the role of intermediation. Intermediation is taking funds from surplus spending units, that's those who have excess, and then channeling them to deficit spending units, that is those who have need for spending but don't have the money. Now, by financial institutions coming to bridge that gap of linking the surplus units and the spending units, what really happens is that they are taking monies from those who have and giving to those who don't have. And most importantly, this is geared towards fueling economic growth by fueling economic activities. In essence, when there's intermediation or funds are made available through the financial services industry, growth and development happens. Now, if there's anything that works against this medium, it means there will not be funds being provided by the surplus units because they're going to hold on to their funds for fear of problems. And what it also means is that ideas that would ultimately stimulate economic growth and development will not be funded appropriately. So for that reason, the financial services industry is quite well regulated because anything that triggers a market failure has very negative consequences for economic growth and development. Now, one of the important market failures that provide a rationale for imposing regulation are information asymmetries, meaning that there's unequal flow of information between two parties to a contract. So sometimes we call for delegated monitoring or credit rationing. And then there are also negative externalities that can cause the risk of bank runs and system-wide panic. So regulations are usually targeted at trying to remove these market failures or at least alleviating the potentially negative consequences. Now, when it comes to integrating MFIs into existing regulatory framework for banks, it can be looked at from three different angles. Either to accommodate microfinance under existing banking law, create a special law, or issue an exemption under the existing law. A tiered approach, in the case of Ghana, allows different financial service providers to be under different institutional forms. So let's see how that plays out. Now, there are a number of reasons to provide for prudential regulation, regulations that requires banks to behave in a certain way and report to their supervisors accordingly. Now, the main reasons for prudential regulation of depository institutions are: one, to protect the country's financial system, as already mentioned, by preventing the failure of one institution from leading to the failure of others, and two, to protect small depositors who are not well positioned to monitor the institution's financial soundness themselves. So in doing that, there are elements like minimum capital, which is expected to be high enough, one, to cover infrastructure, information systems, and startup losses to reach a viable scale. Minimum capital should also be high enough to provide incentives for adequate performance and continued operation. And minimum capital should be high enough to avoid overburdening the supervisor. Now, advocates who see regulation primarily as promotion usually want very low minimum capital. But there's the other handle that, or the other glade that says that if you allow more licenses, you foster competition and access to services. But it is not always going to be the right policy. In many microfinance markets, the vast majority of the clientele is being reached by 5 to 10 large MFIs. So if you end up licensing many small entrants, you may not necessarily produce enough new outreach to justify the supervisory burden, meaning that you're going to have a lot of MFIs, but not enough logistical framework to supervise them and ensure that they behave appropriately. For this reason, there's a need to sometimes ration the number of licenses at an early stage, because you see a trade-off between the number of new institutions licensed and the likely effectiveness of the supervision they receive. Too many at a point would mean that effectiveness of supervision is going to be constrained. Now, the cost of effective prudential supervision is higher for microcredit portfolios than for normal banks, for which reason overstretched supervisory capacity can result in reputational issues for both the supervisor and losses to depositors, which presupposes also that the lower the minimum capital, the greater the likely number of entities that will have to be supervised. Now let's look at capital adequacy. Capital adequacy typically is capital that is made available to support the risk-weighted assets that financial institutions have in their books. So there are strong arguments and experiences to support the imposition of higher capital adequacy standards for MFIs, because given that capital adequacy is more of a response to the risky portfolios that a financial institution has, MFIs typically have higher risk within them. So then there's also strong arguments to push for higher capital adequacy. Now, a higher capital adequacy ratio means that less risk to depositors and the financial system, less funding from deposits, which lowers profits and makes the intermediary less attractive for investors, reduction in poor people's access to loans and other financial services. So whilst it can provide less risk to depositors and the financial system, it could also have unintended or possible consequences. The regulator therefore needs to balance safety and access when setting capital adequacy norms. So why do we need to impose higher capital adequacy ratio on MFIs? Now, particular features of a microloan portfolio, so in this case, microloans are usually unsecured and delinquency can be contagious. So that is why these particular features can actually, support the imposition of high CAR on MFIs. There are also high administrative costs. Delinquency will decapitalize an MFI much more quickly. Now, portfolio diversification issues, substantial covariant issues, and narrow geographic areas. And then maturity of management and systems. So there are challenges to asset and liability management of a deposit taker. And then limitations of supervisory tools. So there's little experience with judging and controlling microfinance risk. So some tools such as stop lending order may be counterproductive. So there are reasons why there's a need or there's an argument to impose higher capital adequacy ratio on MFIs. Now, when it comes to reporting requirements, reports should enable supervisors to conduct the analysis needed for effective supervision. Regulation must also consider that MFIs may be unable to comply with some requirements for banks in general, more because of their size and other intrinsic characteristics that they have. Now, reporting to a supervisor can add substantially to the administrative costs for an intermediary, and reports should include financial statements, external and internal audit, and information on portfolio quality. So these are things that the MFI should report on to enhance or to enable effective supervision. Now, who should perform the MF supervisory function? In most cases, the best supervisor for depository MFIs will be the authority responsible for banks because you're taking deposits. And it's not easy to delegate that supervision effectively, which therefore goes back to the issue of putting a bit of a cap on the licenses that are issued. Now, self-regulation and self-supervision may not be the case here because it's always going to be a gamble against very long odds. And in general, financial cooperatives, at least larger ones, will need prudential supervision. When it comes to Ghana, the general regulatory framework for MFI operations in Ghana include the Banks and Special Deposit Taking Institutions Act, Act 930. We also have the Non-Bank Financial Institutions Act, the Companies Act recently adjusted, Act 2019, Act 992, and then the Bank of Ghana Operating Rules and Guidelines. There have been additions on requirements on fit and proper and governance, corporate governance guidelines as far as financial services are concerned. Now in Ghana, we have categorization of activities for the other non-formal or the beyond the mainstream banking sector. So we have tier 1, and this is usually for the rural and community banks, finance houses, savings and loans. And these are under the Banks and Specialized Deposit Taking Institutions Act. We also have tier 2, which is the next level. So tier 1 have thresholds on activities they can undertake and what accounts they can issue out. Tier 2, typically, that's the microfinance, susu companies, etc., that are deposit taking and profit making. Credit unions fall under tier 2. However, they are not regulated under they have a different regulatory notice, which is the Cooperative Credit Union Regulations 2015, LI 2225. Then we have tier 3 activities that are taken by money lenders, typically in terms of institutional money lenders, and non-deposit taking financial NGOs. So these do not take deposits, but they make funds available. And then we have tier 4. These are susu collectors, whether or not previously registered with the Ghana Cooperative Susu Collectors Association, and individual money lenders. Now, when it comes to regulatory requirement, tier 2, that's for our MFI segment, which is the focus of this course. The following regulatory and supervisory requirements apply. Except for credit unions, all companies that undertake tier 2 activities like MFIs must be limited by shares. Companies undertaking tier 2 activities shall include the word microfinance in their names. And tier 2 institutions shall, in addition to having the minimum capital requirement of setting up, must also maintain a minimum capital adequacy ratio of 10%. Branch expansion is subject to approval by Bank of Ghana, and then it also requires a compliance with higher capital requirements as will be determined by the Bank of Ghana. In terms of permissible activities, they can accept deposits from the public, but no single deposit shall exceed 5% of the company's paid-up capital. They can make loans to their customers subject to the following constraints: a ceiling of 5% of the company's net worth for unsecured exposures, meaning that when they give loans that are not secured by any form of collateral, it cannot exceed 5% of the company's net worth. Secondly, there's a ceiling of 20% of the company's net worth for secured exposures, meaning that at any point in time, even for secured, meaning that where collaterals, etc., have been provided to secure the facility, any loan cannot exceed 20% of the company's net worth. And then there's a ceiling of 1% of the company's net worth per member of the group for group loans. When it comes to Tier 2 institutions, they may only undertake other services with prior rating authorization from the Bank of Ghana. So typically they do not issue checking accounts, like accounts on which checks are written for clearing. They cannot engage in foreign exchange business, and then they cannot engage in any trading activities or hold any stocks for goods for sale to clients. So these are non-permissible activities. In recent time, there's been a revision of the minimum capital. Paid up capital required for rural and community bank licenses 1 million, and those who were in existence must meet or were to meet that by 31st December 2017. So this is to help beef up the system. For Tier 2 and Tier 3 MFI license, it was 2 million, and they were given a date to make that good. Now, when it comes to minimum paid up capital for financial NGOs, it still remains at 300,000. For these are usually non-deposit taking, so the requirements a bit on the lower side. Now that brings us to the end of the lesson in terms of regulation. You may read more in terms of the underlying documents to gain insights into regulation. In terms of review, it will be good to focus on the rationale and objectives for regulation, challenges that regulators or supervisors face while seeking to integrate MFIs into existing regulatory or supervisory framework for banks. Explain why it may be necessary to ration the number of new licenses issued at early stages. Justify the need for higher capital adequacy requirement for MFIs, and describe the permissible and non-permissible activities of MFIs in Ghana. We have come to the end of this lesson. I hope you had a great time. Bye.